How is everyone doing? You are in the strategy room here with the banker next door, your host, Dr. Joe Berquist, and I'm here with you for perhaps 2 hours, maybe it's just a tad over of action-packed adventure. Maybe not quite, maybe not quite all that, but we're going to have some fun here today. I have the usual show here lined up for everybody. Now, I am doing this in the afternoon today. Unfortunately, I have a lot of stuff going on tonight and had to move it around a little bit next weekend as well. With Mother's Day coming up next weekend, I might have to move some things around a little bit. Got to keep the ladies in your life happy. That is for sure. So okay, but before I get started, I just wanted to make note. So last week during the live stream, as I'm going through the articles, there a red banner starts flowing up across the screen, and it basically is like, yeah, shooting at the ballroom wherever the White House Correspondents' Dinner was at. And I had to say, like, it freaked me out for a minute because I started seeing that about an hour into the show last week, and then like every article I was going to is like red line across the screen. And I didn't want to like stop the show like right in the middle of everything to try to break live news or try to break off to see what was happening. But it was a very interesting, like I said, just want to make it was a very interesting thing last Saturday night. I guess I could have tried to break live news like live. That would have been a little interesting, but anyway. All right, I digress. So we've got a lot to talk about here in this week's live stream. So we got a lot of Fed stuff going on. So Kevin Warsh, basically the path is now clear for him to finally get confirmed as the new Fed chairman. So we're going to talk about that in a little bit. The Fed made their interest rate, the FOMC that is, made their interest rate decision this week, deciding not to do anything, basically just to hold everything on just hold everything status quo, if you will. So we're going to take a look at the Fed's FOMC statement and dissect that, break that down a little bit. And then, of course, the huge news coming from Jeremy Powell that he's not leaving. And that's a massive, massive thing. And so we're going to get into all that. We're going to talk about that. We're going to talk a little bit about the Iran situation. We're going to look at how gas prices continue to go up. We're going to look at inflation. The one big indicator, the PCE index for the Fed, came in this week, and not looking so good at the moment. Neither are gas prices. So we're going to talk about that. A lot of just different news. We had the farm bill getting passed by the House. We had the central bank digital currency bill failing in the Senate. Major failure there. So we got that to talk about. We're going to talk about a lot of bank M&A news that I've got sitting teed up for everybody. A little bit of private credit information, a little bit of prediction market information for this week, and then just a ton of other stuff. Just a lot of other general banking news that I have for everybody as well. So with no further ado, we will jump into it as we normally do here. So this is the United States debt clock. And as you can see, the U.S. national debt is up to $39.1 trillion. That equates to a debt per taxpayer of $114,034. It also equates to debt per taxpayer of $357,070. The U.S. federal budget spending is over $7.1 trillion, with the U.S. federal budget deficit at about $1.6 trillion. So, and it's, little discouraging. I mean, basically, the Trump administration has been able to make a dent, just a small dent, because we were at about 2.1 trillion U.S. federal budget deficit when they took office a little over a year ago. But that is, and they've been able to get it down to, like I said, about a 1.6 trillion. So they've been able to cut it down probably about $400 billion. So, like I said, making a dent there, but not making anywhere near enough improvement. Not getting, I mean, the goal was to get this back to a balanced budget and then to come up with some kind of plan for how can you address the national debt. And we're going to see here in a few minutes, I've got a couple articles here as the debt to GDP for personal debt basically just went over 100%, and it's just, I mean, we're starting to get to a point of utter ridiculousness with how out of control the government debt and the government spending is. And again, I think what's really unnerving is that there just seems to be no plan. Like nobody has any plan. The Democrats have no plan. The Republicans have no plan. I mean, nobody. And what's even crazier is that nobody even wants to attempt. They don't even want to attempt to put something out there, because the only way that you can address this is to reduce spending. And neither party has any appetite to reduce spending. They want to spend money like drunken sailors, and that's it. So anyway, all right. So again, the debt to GDP. Now, this is the federal debt to GDP, because I don't want to confuse anybody. What we're going to talk about is consumer debt. In a few minutes, when we get to those articles, we're going to talk about consumer debt to GDP crossing the 100% barrier. The federal debt to GDP is at a 122%. It actually came down a little bit. Not sure why that came down a little bit, but we were almost at about 125% a week ago, and now it's come down to 122%. So again, not really, I mean, again, national debt just continues to go up. So I'm not sure why that debt to GDP ratio shrunk just a tiny little bit. So, and then defense spending still at $936 billion. The interest on the national debt, again, as I reported just a couple weeks ago, now over $1 trillion just to service the national debt. That doesn't pay down $1 of the debt that's owed. That is just $1 trillion just to service it. Credit card debt sitting at over $1.3 trillion. That equates to a debt per holder of $8,251 on average. So there is that. Now let's jump into some the overview for the week here. So the stock market had pretty good week for the most part. The S&P 500 continues to go up to new records. NASDAQ looking good. Dow had a little bit of a down day yesterday, but overall was pretty decent for the week at 49,499. So nothing really too bad there. Currency, let's go to the bonds. So let's take a look at interest rates here for a second. I want to key in on the 10-year Treasury note, as that is the most important one, and that tells us a lot about just where interest rates are at. So the 10-year Treasury had spiked up to over 4.4%. Not good, and going in the wrong way. Then, yeah, and again, you can see here from the chart, if everybody looks at this, you kind of see here, oh, sorry, I lost it there for a second. You kind of see here this blip up here. And again, this is just in the last 24 hours. You see this blip up to, 4.4%, and then it comes right back down to 4.348. And we're basically sitting at 4.379 right now. But again, this is just, you're seeing these massive shifts based on whatever news is coming out about Iran. You have to, the strait is still blocked. Okay, gas prices going back up. Oh, wait, they're working on another peace deal. Oh, it comes back down. So, we're just constantly stuck in this shifting of narrative and what is basically driving the interest rates here right now, especially in the bond market and the Treasury with the Treasury notes. So it's really kind of frustrating. You're constantly hoping every day that just something good comes out that basically says, hey, this thing's going to be over relatively soon and we can put this behind us, and then that will be that. But that just doesn't seem to be the case. So, and again, as I've pointed out in the shorter bills, the 1 month bill, the 6 month, the 3 month, the 1 month bill, they're all trading in this very tight range of 3.6, almost 3.7%. And it's kind of interesting how they have just, those short bills have just stayed trading in that very, very tight range. Like I said, you usually don't see that. Usually there's a little bit of separation there between the shorter bills, but you're just, like I said, for the last, month or two, that has just not been the case. 2-year Treasury note is still there at 3.8. 92%. So again, the 10-year minus the 2-year gives you your yield curve. Yield curve still at about 50 basis point difference. So still a decent difference there. So yield curve still in positive territory, which is always, always good. Probably next week, I'll probably get back. I haven't really done a big conversation on the yield curve here in the last few months. I'll probably get back to that, do maybe a little 5-minute conversation on that next week's live stream. So let's take a look at some cryptos for just a second. So Bitcoin getting back up over 70,000, now up to 78,450. So, Bitcoin coming back up a little bit, but the stalling in crypto legislation is really holding Bitcoin back. And we're going to talk about the CBDC, the central bank digital currency bill, and that failing this week. And like I said, that was one of what I called the three-legged stool of the crypto regulation. And obviously having that fail it's a big deal. It's a very, very big deal. We do not want the Federal Reserve to be able to issue a central bank digital currency. We just don't want it. It's not good for anybody. And as they leave the door open, you've always got that. There will always be those people that will say, "Hey, let's do that," because as I pointed out just a minute ago, this $39.1 trillion in national debt. And you know how I just said that, like, oh, nobody really wants to come up with a plan to deal with this, right? Well, I can almost promise you some genius out there is going to go, crypto. Crypto is our answer. That's what's going to solve all this for us. Yeah, we need to dump the dollar and we'll just go into crypto, but not any crypto. No. Not any crypto. It's going to be a central bank digital currency that the Fed can fully and completely control. That I promise you, that will be one of the proposed answers to this whole problem, the debt problem. I could guarantee you coming in there. So, all right, let's take a look at residential mortgage rates for just a second here. So this is as of today, May 2nd. So according to rates from the Zillow Lender Marketplace, fixed rate loans moved higher for the second week in a row as tensions in the Middle East continue to drive energy prices higher for countries around the globe. According to Zillow, the current 30-year fixed rate is 6.2%, up 11 basis points this week. Meanwhile, the 15-year fixed rate is up 8 basis points this week to 5.66%. So as we take a look at our mortgage rate, so the 30-year fixed rate is hanging in at 6.20%. 15-year fixed is at 5.66%. The 5/1 ARM is at 6.12%. And the 30-year VA is at 5.73%. So again, I kind of said all this last week too. It's like, this is not horrific. Like, we're not seeing anything horrific here. We would like to see the rates a little bit better. I would like to see this back down to 6%, maybe a little bit below 6%, high fives, maybe 5.95, something like that. That's really where I'd like to see these rates get back. They were there just about 2 months ago. They were there, but unfortunately, with the geopolitics, we kind of lost that for a minute. But I would like to see those rates come back down a little bit. But the important thing to note, and I said this last week too, important thing to note is that it's not horrible. Like, these aren't horrible. You can at least you can work with these rates. It may not be the best thing ever, but these aren't rates that are going to massively stop you from getting a mortgage, right? They're way better than the 7.25, 7.5 that we were looking at just a year or so ago. So, okay, and then on the financing side, if you wanted to refinance, the 30-year fixed on a refinance is 6.18. 15-year fixed for a refinance is 5.64. The 5/1 ARM is 5.92. And the 30-year VA mortgage on a refinance is 5.65. So a lot of the refinance rates are dynamite. I mean, again, 15-year fixed, if you're just looking to do a refi, 5.64. The 5/1 ARM is below 6% at 5.92, and the 30-year VA is at 5.65. So nothing wrong there. Nothing wrong with any of that. So, all right, now let's jump into our Fed conversation. So the first we kind of have three parts of this, right? We've got the Kevin Warsh nomination, we got the FOMC decision on interest rates, and then we got the big announcement from Jeremy Powell. So those are the three parts of our conversation here. So starting off the first part, Tom Tillis, and this was last week. This was coming in last Sunday. Tillis drops objection to Warsh's Fed nomination. North Carolina Senator's decision clears the path for confirmation before Powell's term as Fed chairman ends on May 15th. So Senator Tom Tillis said on Sunday he would support Kevin Warsh's confirmation as Federal Reserve Chair, clearing the last significant obstacle to install President Trump's pick to succeed Jeremy Powell. Tillis had withheld his vote for months, saying he wouldn't advance any Fed nominee while the Justice Department's criminal investigation of Powell remains open. The probe appeared to end on Friday when the U.S. Attorney Jeanine Pirro said her office was closing its inquiry into Powell's testimony to Congress about the Fed's building renovations and referring the matter to the Fed's Inspector General. The Inspector General, who reports to Powell, had already been conducting an audit at Powell's request since July. So in a statement Sunday, Tillis said he took the Justice Department at its word that the investigation is closed and that any appeal of a federal judge's March ruling against the probe's grand jury subpoenas will be with respect to legal principles and not for the purpose of reissuing subpoenas. He said that only a criminal referral from the Inspector General would justify reopening the case. With these assurances, I look forward to supporting Kevin Warsh's confirmation, Tillis said. So now we move into this week. So Warsh's Fed chair nomination moves to full Senate vote. So the Senate Banking Committee, including once holdout Senator Tom Tillis, voted along party lines to keep alive ex-Federal Reserve Governor Kevin Warsh's bid to succeed Jerome Powell atop the central bank. So former Federal Reserve Governor Kevin Warsh's bid to succeed Jeremy Powell as chairman of the central bank moved to the full Senate on Wednesday after the Senate Banking Committee approved his nomination 13-11 in a party line vote. The green light came despite vehement opposition from the committee's ranking member, Senator Elizabeth Warren, who called Warsh a uniquely unfit candidate with catastrophic previous tenure as the Fed governor from 2006 to 2011. In opening remarks Wednesday, Warren noted Warsh's role in crafting rescue packages for Wall Street firms during the 07-08 crisis. Despite bailing out Wall Street and selling out American families, he has said repeatedly he has no regrets, Warren said. By contrast, Warren's Republican counterpart, Senator Banking Committee Chair Tim Scott, pointed to Warsh's experience during the financial crisis as a net positive. Frankly, his time as a former governor of the Federal Reserve during the financial crisis makes him battle-tested and ready to serve, and not only serve, but to lead. Scott said in a statement on Wednesday. Much of Warren's argument tied back to pressure President Donald Trump has applied to Powell through repeated threats to fire him, as well as Justice Department investigation and whether the Fed chair lied to Congress about over-budget renovations at two central bank buildings. So now, basically, so Tom Tillis basically dropped his blockage there of the Senate vote. We got the Senate committee vote this week. He passed that. So now we're going to go to the full Senate vote. And I would expect that full Senate vote to probably come in the next week or so, given that Powell's his days as chairman of the Fed are done on May 15th. So again, we've got about 2 weeks here. So I would assume that vote will come prior to Powell's expiration, so that basically they can get Kevin Warsh in there probably just before or right as his term as Fed governor is ending. But just very interesting. I just wanted to point this out. So this was some comments from Thomas Honig, Dr. Thomas Honig, former Fed governor. He was I've done an interview with Dr. Thomas Honig, if anybody would like to go check that out. He was the main character in the book, The Lords of Easy Money. And so I was very curious what Dr. Honig's comments were on Kevin Warsh's confirmation hearing. So he had 4 quick reactions. Number 1, Fed independence is a major challenge confronting Kevin Warsh. Should he be confirmed? Warsh says he will be independent, but he will be at risk almost immediately if confirmed. The president expects Warsh to lower interest rates soon after entering office. If he lowers rates, even for good reasons, he will be accused of being controlled by the president. If he does not lower rates, the president will be highly critical and likely angry. Number 2, The Fed's balance sheet is a second issue for Warsh. In anticipation of Warsh's confirmation, members of the FOMC are discussing the possible shrinking of the balance sheet even as it is growing again. However, shrinking it could disrupt liquidity in Treasury and money markets, especially as new debt is growing at $2 trillion per year. Who else said that? I think somebody else said that. Yeah, I think it was this guy said that. The Fed is faced with the problem of fiscal dominance. In which the central bank's mandate of stable prices becomes secondary to the Treasury's debt financing needs. The most likely policy discussion will be whether the Fed can stop the growth in the balance sheet. I suspect this topic will be slow to develop, and the FOMC, despite Warsh's desire to address it. Number three, Warsh talks a great deal about the Fed staying in its lane, given how broadly the Fed liquidity safety net has expanded. In other words, bailout city. They have the Fed over the last 16, 17 years has turned this into the all bailout, all the time economy. So he and the FOMC will be hard pressed to convince the markets that it will not step in again should non-bank markets experience a liquidity crisis. Yes. So we'll find out when the next crisis hits, and there will be something else guaranteed. What will the Fed do? Will they come rushing in to save the day? We shall see. Number four. Warsh may have his most success if he proposes to end forward guidance. He is convinced and perhaps members of the FOMC are as well, that forward guidance has not served policy goals as well. So yes. I mean, he could get rid of forward guidance and he could stop doing that. But I don't think that forward guidance is going to make any kind of real massive impact on anything. I think the big things are going to be, and again, I don't buy into the whole Fed independence argument. I just think I think that argument is ludicrous. I think it's always been ludicrous. I think there should be a big national conversation about Fed independence. I think it's long overdue. But again, the balance sheet is a very big thing. The bailouts are a very big thing. You know, that's and like I said in the conversation last week, the Fed has turned the economy on its head. And like I said, you have to read the book, The Lords of Easy Money, to really understand and get a grasp of what that means and why I say that. And the problem here is, in order for Kevin Warsh or anyone else for that matter, to turn everything back on its head, to put things basically back the right way or put it back to the right condition, the problem is you're going to have a ridiculous amount of short-term pain. And what that means, I can't really say full, 100%. But what I can say is that it would be very messy and very nasty, and a lot of people would not like it. A lot of people in this country would not like it. I think it would be the best thing, because they would put it back the right way, and then they would basically fix things, if you will, and then we could move forward from there, probably on to some really good days in this country. But I don't think that anybody has an appetite to deal with that short-term pain. So, but anyway, like I said, but I thought that once again, Dr. Honig, I thought he hit the nail right on the head here. I thought all of his comments were spot on. And I just thought he just nailed it, did a great job with that. So like I said, I thought people would share that, some good thoughts and some good comments there. So, okay. Now let's move into the FOMC statement and the policy decision by the FOMC. So Fed holds rates steady, but with the highest level of dissent since 1992. So an unusually divided Federal Reserve held its key interest rate steady. Policymakers are grappling with the challenge of balancing the threats of persistent inflation and a softening labor market. The meeting likely was the last with Chair Jerome Powell at the helm. He is due to step down from the top job in mid-May, although his term as Fed governor doesn't expire until January of 2028. During a news conference, Powell said he plans to continue to serve on the board of governors until an investigation of the Federal Reserve is well and truly over, with transparency and finality. So, yeah, we're going to get into this in a second. But, yeah, Jeremy Powell might be careful what he wishes for. And we'll see there. So here is the Federal Reserve. This is their official statement, the official press release that was put out as of April 29th. So let's All right, we're going to read through this here, but before we do that, let me just say here, Jeremy Powell, in his last news conference as Fed chair, unveiled the most divided vote during his tenure. This division may be a combination of the uncertainty caused by global events, as much as it might be individual voting members voicing that they will not be sock puppets to the administration. So the federal funds target rate was held at 3.5 to 3.75%. The market reaction, Fed funds futures are pricing at 33%, a change of about 25 basis points rate hike by April 2027. So the FOMC announced the following actions and analysis. So on an 8-4 policy vote, Governor Miron was the only vote in favor of a 25 basis point rate cut. So the other three dissenting votes here were basically votes that basically said that they didn't want to give any forward guidance. They did not feel comfortable giving any kind of guidance that there would be any future rate cuts this year. No future rate cuts this year. That's what the three dissenting votes wanted. And they actually wanted a policy shift. They actually wanted Jeremy Powell to come out and basically say that not only will there not be any more rate cuts this year, but they might have to increase interest rates. That's what they wanted him to say. He didn't go there, but that's what they wanted him to do. And that's what three of the dissenting voters. Like I said, but there was also some politics at play because those dissenting votes were also sending a message. This was also about sending the message to the White House that basically, like, yeah, we're not going to be your sock puppets. And even if you put Kevin Warsh in here, we're not going to go along with him, and we're not going to vote for the things he wants us to vote for. That's basically what the message was for. So Fed officials say the economy is expanding at a solid pace with low job gains, and the unemployment rate has been little changed, all of which are identical to the March statement. The committee said developments in the Middle East are contributing to a high level of certainty about the economic outlook. The committee also noted that it is prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. These goals are price stability and maximum employment, i.e., raise interest rates if we have to. That's really what they're saying here. So, okay, let's look at the statement now here. So, recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low on average, and the unemployment rate has been little changed in recent months. Inflation is elevated, in part reflecting the recent increase in global energy prices. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook. The committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared. Let me scroll down there so everybody can see that. The committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So I think, what's interesting about that last sentence? The committee's assessment will take into account a wide range of information. I find that very interesting, given the fact during Kevin Warsh's testimony last week during his confirmation hearing, one of the things that Kevin Warsh talked about was basically wanting to use new data or different data or alternative data than some of the data that's currently being used by the Fed to gauge a lot of the inflation and employment picture. So I find it very interesting that they snuck that, they snuck that in there almost as a way to say, like, hey, man, you want to criticize us. Well, guess what? We're already using a wide range of information. So, like I said, this, again, this Fed is just, it's so fascinating on so many levels, just because of the, the politics has really gotten crazy. And now, again, with the whole thing with Lisa Cook and her potential mortgage fraud, with Stephen Mirren being appointed onto the board, and now his time there is almost over. So Stephen Mirren is gonna be moving on. You really have, I mean, we could really see something very wild here with the FOMC over the next year or two, where we could see just major descent. We could see a Fed that basically almost like implodes on itself in utter peril, because we're going to have these factions now that basically see the world very differently, see the Fed very differently. And I don't think that there is any doubt that Kevin Warsh, if he's serious about the things that he wants to do, and he comes into the Fed and he's going to try to actually try to make some changes. Not, and again, I'm not saying that Kevin Warsh is going to fire everybody and he's going to change all this and change all that. I don't know that I don't think it's going to be anywhere to that extreme level. But he might try to make some very significant changes, like I said, as it comes to forward guidance, as it comes to the Fed's balance sheet, as it comes to moral hazard, and whether the Fed will actually bail people out when they come looking, when they have problems and they come looking for the bailout. If he doesn't want to do some of these things and he wants to change some of these things, there will no doubt be major factions in the Fed that will fight him tooth and nail on some of these things. And so again, what we are about to embark on here could be very wild over the next couple of years here. But let's look at something here. So here's what changed in the Fed's statement policy. So we can see here at the top in the first paragraph, they changed available to recent indicators. They added in there, job gains have remained low on average. So basically, to put a more emphasis on the fact that job gains have continued to remain low. Inflation, they took out, remains somewhat elevated, and just is elevated. So inflation now, it's not somewhat, it's just elevated, in part reflecting the recent increase in global energy prices, which was added in there. They took out uncertainty and they put in just developments in the Middle East are contributing to a high level of uncertainty. So they kind of changed that up a little bit. About the economic outlook, they took out remains elevated, and the implication of developments in the Middle East for the U.S. economy are uncertainty. So they scratched those sentences. And then down here at the bottom, they added in there, and Beth Hammack, Neil Kashkari, and Lori Logan, who supported maintaining the target range for the federal funds rate, but did not support inclusion of an easing bias in the statement at this time. So those were the other three dissenting votes outside of Governor Stephen Mirren. So those were the changes there in the Fed statement. Now we go to Fed dissenters explain their no votes, saying they disagree with hinting that the next move would be a cut. And this is, like I just said a few minutes ago, Federal Reserve officials who voted this week against the post-meeting statement said they didn't think it was appropriate to signal that the next interest rate move would be lower. So see, these guys are already against forward guidance, right? See, funny how that works, right? They're already against forward guidance. When it's something that they want to do, then they're all for it. Okay, but then the minute, so it'll be interesting. Like I said, when Kevin Warsh gets in there, if Kevin Warsh is like, yeah, I want to get rid of forward guidance, okay, they're basically telling you right here that they want to get rid of forward guidance, that they don't want any signaling that there will be any kind of rate cuts in the future. They don't want that at all. So it's just, like I said, just kind of interesting there. Regional presidents Neil Kashkari of Minneapolis, Lori Logan of Dallas, and Beth Hammack of Cleveland released statements explaining their votes, offering similar rationale regarding the verbiage in the statement, but not over the decision to keep a hold on rates from their current position. Kashkari said the statement contains a form of forward guidance about the likely direction of monetary policy, given recent economic and geopolitical developments and the higher level of uncertainty about the outlook. I do not believe such forward guidance is appropriate at this time. So he wants to give forward guidance, but just doesn't like that type of forward guidance. So, okay, splitting hairs there. Instead, he said the FOMC committee statement Wednesday should have indicated the next move could be a rate could be a cut or a rate hike. This was the third consecutive pause for the committee after it cut 3 times in the later part of 2025. Similarly, Hammock said she didn't agree with the decision to indicate an easing bias around the future path for monetary policy. I see this clear easing bias as no longer appropriate given the outlook, she said. Hammock noted that inflation pressures continue to be broad-based as the Iran war and the subsequent surge in oil prices pose a threat to the Fed's 2% goal. Logan also said she is increasingly concerned about inflation getting back to target. The conflict in the Middle East raises the prospect of prolonged or repeated supply disruptions that could create further inflationary pressures. At the same time, the labor market has been stable with low unemployment and payroll job gains keeping pace with labor force growth, she said. The economic outlook is highly uncertain, however. Moreover, Logan said the so-called forward guidance part of the FOMC statement is an important policy tool on which households and businesses rely on to make future plans. So again, just a very interesting comments here from these dissenters, if you will, in the Fed conversation here. So we will have to see, we'll have to see how this whole dissenting votes continue in the months and over the next year or so. If and again, we're about to pivot to the conversation on Jeremy Powell and his decision to basically stay on as Fed governor. So with him staying, the big question is with him staying on as Fed governor, is he now going to basically lead this revolt within the Federal Reserve, within the FOMC committee, to basically try to just say, no, we're not going to allow you to get any votes passed. We're not going to allow you to get anything done. And what Jeremy Powell here is doing is completely unprecedented, as we're about to see here in a second. But like I said, just one last note here on the dissenters. I mean, we could see something wild here. We could in the next few months, the next year or so. The dissents could be unlike anything we have ever seen. And like I said, so I just something to note as we move forward. And like I said, I continue to do these live streams into the future. It's something we're going to keep a close eye on. So now the big bombshell here. Jeremy Powell says that he will continue to serve as Fed governor and calls Trump criticism unprecedented. So basically both sides are playing the unprecedented narrative at the moment. So, but Fed Chair Jeremy Powell on Wednesday said he will stay on the Board of Governors for an indefinite period while a probe into the renovation of the central bank's headquarters continues. Well, first of all, he can't stay for an indefinite period because his term only lasts until January of 2027. So he can't hang out here for like an indefinite period, but he can potentially stay for the rest of his term. So the statement resolves, for the moment, a key question that hovered over the Federal Open Markets Committee meeting. The things that have happened really in the last 3 months have, I think, left me no choice but to stay until I see them through at least that long. So, but here's my problem with this, and you could see what he's doing is total BS. It's total BS because they dropped the investigation. They turned it over to the Office of the Inspector General, which is in the Fed, and it reports to him. So where's the investigation he's talking about? Where is this? Oh, they're going to come after me, or they're going to do this, or they're going to do that. Well, unless he's worried that he's not going to be able to control the people at the Office of the Inspector General, that the people at the Office of the Inspector General are going to come back and recommend some type of criminal action against him. Maybe that's what's got him worried. And I don't know. Maybe he should be worried about that. But this is ridiculous. It is obvious. It's painfully obvious that Jeremy Powell is staying on here just to be a thorn in Trump's, you know what. And he's only doing this to basically be an obstructionist, to be an absolute obstructionist, to obstruct Kevin Warsh, to try to ruin Kevin Warsh's tenure as the new Fed chairman. That is what his goal is here. It is as plain as day. That is what he is seeking to do here, and it's disgusting that he's gonna do this. And yet at the same time, at the same exact time, he will cry all day long about Fed's independence and maintaining the Fed's independence. Yet, ironically, he is doing more to destroy the Fed's independence than anyone else. And this is what I've been saying for the last year. He had, through all of his I mean, it is beyond question Jeremy Powell's politics, his political bias, his political leanings. I mean, it's all there for everyone to see. It's like all you got to do is read between the lines. He's telling you exactly where he stands, who he stands with, what he believes in, and he is there to, like I said, from day one with Trump going back in, he is there to be an obstructionist. And like I said, with the whole interest rate thing last year, it's like, okay, he brought rates down 75 basis points. Okay, fair enough. Did he bring them down anywhere near where they should have been brought down to? No, he didn't. Did he bring them down as quickly as it should have been done? No, he did not. He drug his feet until finally he did lower. Okay, just so he could say, oh well, hey, I lowered. He wanted me to lower rates. I lowered rates. I gave him something, And again, that's it. But he's just operating here as the ultimate you know what, and it is so ridiculous. It is so ridiculous that he is doing this. But I will say this: if he doesn't want to leave and he becomes this big obstructionist, and then you see Trump come out and basically Trump starts saying, you know what? Forget the Fed's independence. And yeah, we need to start really taking a look at the Federal Reserve Act. We need to open that back up. We need to start taking a look at what's going on here. If that happens, Jeremy Powell will have no one to blame but himself. Nobody to blame but himself, because he will have brought all that on. He will have brought that on. So it's just wild. And then let's look at a couple other things here. So Powell to remain on Fed board, citing legal pressure from Trump. Basically, Federal Reserve Chairman Jerome Powell said Wednesday that he would stay on the central bank's board after his chairmanship ends next month to defend the institution for what he called unprecedented legal attacks from the Trump administration. His decision marks a departure from decades of precedent and overshadowed deepening divisions over the path for interest rates. Powell announced his decision Wednesday after officials extended an interest rate pause, but were split over whether to continue hinting at further rate cuts, an uncharacteristically contentious end to Powell's 8-year chairmanship. His term as chair ends May 15th, but a separate term as governor allows Powell to remain at the Fed until early 2028. Oh, I might have said 27 a minute ago, but yeah, it's 28, January of 2028. So for decades, Fed chairs have left the building when their successor is installed. Yes, and there's very good reason and precedent for that. His decision highlighted how an unprecedented public campaign to pressure the Fed to lower interest rates has further complicated the handoff to Kevin Warsh, the former Fed governor chosen by President Donald Trump to succeed Powell. My concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors, he said. I worry that these attacks are battering the institution. Yeah, it's like, you know what, dude? Yeah, it's, you know what? Get out of here, man. Get out of here. It's just ridiculous. I'm worried about our ability to conduct dude, nobody's stopping you from conducting monetary policy. Okay. Nobody's stopping you. And as many people have stated, every president has the right to question what you are doing. Every president has the right to their own opinion. Every president has the right to state their opinion publicly as to what they feel that you should be doing. They have the right to disagree with you. Again, I thought we lived in a free country. I thought that everybody was entitled to their own opinion. If the president doesn't like what the Fed is doing, the president has every right to call them out for it. This idea they want to hide when they are not doing the right thing, and when they are not helping the American people, they have every right to be called out for that. Every right. So for him to sit there and be like, crying, these political factors, whatever. And again, the irony is just dripping here from this. The irony is dripping because the irony is the one who is playing politics is Jeremy Powell. He's the one who's playing politics here, which is, again, it's wild. This whole situation has been wild from day one, without a doubt. So, okay. And then we go into Kalshi. So our good prediction markets. So Kalshi users called it. Powell says he will stay on as Fed governor after the chair term ends on May 15th. So Kalshi users had placed a 30% chance that Powell would resign as a member of the Fed Board of Governors by June. I've said that I will not leave the board until this investigation is well and truly over with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully, Powell said near the beginning of his post-meeting news conference on Wednesday. So here we have the Kalshi markets. They had about a 20% chance that he would leave before June. Then we've got a 62% chance that he'll leave before August. And there is a 81% chance he will leave before 2027. So basically, a lot of people feel that he will leave before the end of the year, but he's going to be hanging out here for a little bit longer. We'll see. I would not be surprised to see these bets here, if you will, on Kalshi. I wouldn't be surprised to see these alter maybe into 2027, but we'll see. We'll see what happens with that. So inside the Fed, so Powell vows he won't be a shadow chair, but a Warsh clash will be tough to avoid. Yeah, no, there is no doubt that Jeremy Powell is going to be a shadow chair. He's going to be a shadow chair. He is going to clash with Kevin Warsh at every point, every stage, every angle, on every. Yeah, he is there to stay there, to be an absolute disruptor, to just throw just a wrench into the machine. That is exactly what he's doing. So when the FOMC committee gathers again in mid-June, it will mark the first time a sitting and former chair conducts central bank business together in nearly 80 years. The meeting with the incoming chair, Kevin Warsh, was an outgoing. Jerome Powell likely will be less antagonistic. I don't think so, though still with high stakes for policy. Current economic conditions provide little ammunition to argue for policy easings, presenting an early obstacle to Warsh's agenda. So yeah, there's no doubt these two guys are going to be going at it. No doubt. You could mark it, write it down, 100%. Yeah, they're going at it. No doubt about it. That the June meeting is. I can't wait. I can't wait to cover the June meeting because that is going to be must-see TV. I guaranteed. Okay, let's go on here. Powell won't leave, the Fed won't cut, and Warsh will have to deal with both. So a divided committee, external political pressures, and an emergency shock and an energy shock. Kevin Warsh inherits a Fed unlike any his predecessors have faced. Yes, that is a 100% true statement there. So at his Senate confirmation hearing last week, Kevin Warsh told lawmakers that the Federal Reserve needed a serious shakeup with messier meetings and a good family fight at an institution that has cultivated discipline and consensus. He may be getting all of that and more. Yeah, yes, I would say he's going to get all of that and more. On Wednesday afternoon, the man he's set to replace as Fed chair, Jerome Powell, announced that he wouldn't leave right away. Three of Powell's colleagues delivered a pointed warning that they are in no mood to cut rates anytime soon. Every Fed chair for the past 75 years has left the central bank when his or her successor took over. Powell's announcement that he would remain on the Fed's board as a governor after handing the baton to Warsh next month broke with that precedent. It underscored how far the Trump administration's pressure campaign had pushed the Fed into uncharted territory. Powell's decision followed a criminal probe of his oversight. Yeah, we know that. His concern is about the legal attacks. Treasury Secretary Scott Bessent said it was Powell and not the administration who was violating established practice. For someone who says he's an institutionalist, Bessent said, this is a violation of all Federal Reserve norms. Absolutely. Scott Bessent, absolutely, 100%. Scott Bessent is correct. Powell wasn't the only Fed official making a statement on Wednesday. So again, these are the three governors that broke and dissented. We talked about that already. Let's see here. Number of dissenting votes at each Fed Open Market Committee meeting. So again, through the three dissenting votes, again, so this is through the years from as you can see here, 1981 through 1990. A lot of dissent there among, Fed governors. Then as we got into the 2010s, the financial crisis, you saw a lot of dissenting votes there from regional bank presidents. but not so much from the Fed governor. Very little from the Fed governors in this period. Very little. And that's one of the things. This is one of the things. This again, this chart is very interesting on the left here amongst the Fed governors because it tells a very interesting story. So you can see here what happened in 1992. Well, Alan Greenspan takes over as head of the Federal Reserve, and from 1992 all the way up here through almost up until the last year, you had very, very little dissent in there. And this is what makes Dr. Thomas Honig, who gets talked about in the Lords of Easy Money, in his very famous dissents in 2010, when he did not want to go along with quantitative easing and the zero interest rate policy, ZIRP. He didn't want to go along with these things, and he dissented his opinion against that. But outside of that, it started with Alan Greenspan, but then Ben Bernanke, when he stepped in 2006, he kind of took the culture to the next level. And they all of these Fed governors over these last 4 Fed governors here over the last 30 years, they have all kind of preached this no dissent. They don't want dissent at their meetings. They don't want dissent at their meetings. And if you do dissent, you're going to find yourself on the outside looking in pretty quick. And that's what happened to Dr. Thomas Honig. His term was up, and he was like, "Hey, see you later." And that's basically what you've got. So again, seeing at least some of this dissent now in the last year is very interesting when you look at this chart. So again, just wanted to point that out, and then let's go on here. So this was an article that is a joke, but I wanted to point it out here because this is why Powell is right to stay on the Fed. His presence raises the stakes should Trump renew his attacks on the central bank's independence. So right here, this is the propaganda arm of the Fed putting out this garbage in the Wall Street Journal here. They've got their lapdogs out there right now defending Powell. Powell's fine. He has every right to stay. We don't care if it's unprecedented. He could do what he wants, and he's doing the right thing, and he's fighting for the Fed. He's putting up the good fight. BS. It's all BS, and it's so ridiculous that you get this crap in the Wall Street Journal, but they have no doubt in putting it out there. But like I said, I just wanted to point it out because it's one of the things that drives me nuts. So this article from Investopedia, this was pretty interesting. So how Jerome Powell's record stacks up against previous chairs. Now, let's go down. This is a very interesting chart here. So what we have here in the green is PCE, basically inflation, the inflation index. And then in the blue, we have unemployment rate, and then the misery index, or the what's called the VIX, the fear gauge on Wall Street. Basically looking at these 3 parameters to basically say, okay, based on this, let's look at how these other Fed chairmen, how they fared, right? And so basically trying to create the case for Powell that basically like, well, things haven't really been that bad during Powell, the unemployment rate has been under 5%. That's been pretty good. The VIX has only been at 7.6%. When you compare to Ben Bernanke at 9.4, and all these, and Alan Greenspan at 8.1, and Paul Volcker at 13.3. And hey, look, the inflation gauge has been about 3%. But it hasn't really been all that bad. So again, just trying to make the case here. But I don't think that this really washes. I don't think that this is a good barometer, if you will, for trying to judge what Jeremy Powell has done as the Federal Reserve. I think there's a lot of other things you have to look at. I think you have to look at the massive inflation that occurred on his watch because he pumped $5 trillion into the economy. I think you have to look at the balance sheet. You have to look at what has been done with liquidity in the markets, and how he has managed the balance sheet and manipulated a lot of stuff over the last 8 years. Those are things that I think are much better gauges of his performance as Federal Reserve Chairman, aside from this. But again, this was interesting. It was an interesting thing I wanted to put out here. Now, one thing I want to point out, this guy at the end here, G. William Miller, he only served as Fed chair for 1 year. So I'm not sure how. I mean, I know he was right before Paul Volcker, but he was only on there for a year. So how can you include him on this chart here? And then Paul Volcker, Paul Volcker did an amazing job as Fed chair, and he was not a beloved chairman because Paul Volcker was not afraid to tell it like it was, and he was not afraid to demand big changes at the Fed or have them change some of their policy, and he wasn't afraid to go toe to toe with people over there on it. And so he had a very difficult job, and despite all that, he did an amazing job. And he was probably Paul Volcker was unquestionably one of the best Fed chairs ever. But like I said, he didn't win a lot of friends over there. He did not win a lot of friends over there, and he got booted out. And they went with Alan Greenspan, who was a much more political animal, and he knew how to kind of massage everything and keep everything status quo, keep everybody happy, keep everything going along. He was a lot different from Paul Volcker, but he also didn't have to deal with some of the things that Volcker had to deal with, but he did have to deal with a lot at the very beginning where he had to deal with the savings and loan crisis, the recession there in 89, 90, 91. So he did have some things at the beginning of his term that he had to deal with, but Allen's legacy is bubbles. He was the one that ushered in the age of bubbles, the bubble economy, and starting in 2000. That is whether he likes that or not, that is his legacy. He brought us the bubble economy. And then Bernanke, Janet Yellen, and Jeremy Powell, the three amigos, they have just carried it forward. So all right, that's wait, I got one last thing here on the Fed conversation. So inflation could get in the way of Warsh's desire to cut interest rates, according to a CNBC survey. Yeah, we kind of already know this. I mean, based on what the dissenting votes from those three Fed governors, basically they don't. My take on that is that they don't really care about the employment market, right? They're not looking at the employment market. Their sole focus is on inflation. And as long as inflation remains elevated, they are never going to basically vote for a rate cut. They are basically also always going to say, no, inflation is too elevated. We got to get back down to the 2%, and there's nothing we can do about it. And one of the interesting things about that, I actually have another article. I'll have to share this next week because I don't have it teed up and I don't have it. But Warren Buffett actually came out with and I wanted to share that with everybody. He came out with some very interesting comments a week ago, where basically Warren said that the whole 2% argument from the Fed was nonsense because wait for it, the Fed could eliminate basically all inflation by, wait for it, doing what? Eliminating their balance sheet, reducing their balance sheet, stop pumping money into the economy, stop paying money out on stop paying high interest out on bank reserves that causes them to lose hundreds of billions of dollars. Stop doing all this stuff, and you could reduce inflation to zero. That was not me. That was from Warren Buffett. That was Warren Buffett saying that. Now, like I said, I'll share that next week. I'll come back to that next week because I just think that that was very important to point out, that basically like the Fed could gripe about the inflation, but the Fed is ultimately responsible for said inflation. So, all right, let's go to Iran here for just a second, because I wanted to point a couple of things out here. So the stalemate, if you will, continues. The Strait of Hormuz, every day it's like it's open, it's not open, it's open, it's not open. Every day it seems like we got a peace talk, we don't have a peace talk, we have a peace talk, we don't have a peace. We're just on this seesaw going back and forth. But there's a huge but. But while the seesaw is going back and forth, there are a lot of big things happening, a lot of really massive things happening. And this is the first one. Iran faces imminent oil shut-ins as storage nears capacity. So U.S. Treasury Secretary Scott Bessent says Iran's fragile oil wells could shut within days as sanctions and naval blockade squeeze storage and exports. So Iran is nearing forced oil production stoppages as storage tanks fill rapidly, with capacity set to be exhausted within 20 to 24 days, according to an April 22nd update from Kepler. a commodities data firm that tracks global oil, gas, and shipping flows. The firm said that Iran's output has already fallen by about 750,000 barrels per day from pre-war levels, primarily because of lower domestic demand during the Iran war. It said that Iran's oil supply is being forced to adjust to two simultaneous shocks: damage to key infrastructure and an almost complete halt in exports. So, their capacity is set to be exhausted within 20 to 22 days. And that was according to a report or an update from April 22nd. So that would take us out. So 30 days in April. So we are looking at another 12 days. So about May 12th to May 16th is when they're going to start to have major problems. So another 2 weeks. So 2 more weeks. We're going to start to see. My prediction is within 2 weeks they come back to the table and sign a real peace agreement, because this is the death knell. I shared an article last week where I pointed out a bunch of charts and graphs. If everybody wants to go back to last week's live stream, you could look at you could look at that 3-minute conversation I had there on Iran, and I pointed out how their economy is just in the toilet. Like, their economy is having major problems, and the ripples from that are really going to start to kick in here very shortly. And that's why I believe that ultimately they will be back to the table here within the next 2 weeks to do something, because their oil supplies are gonna dwindle rapidly. They've got major damage to infrastructure. They have a complete halt in exports, and this is going to drive them to come back to the table. It just is. Let's see here. What else does it say here? So he said that about 1.8 million barrels a day no longer being exported, and roughly 39 billion barrels of storage available onshore. Iran could run out of space to store its oil in about 20 to 24 days. U.S. President Donald Trump said in a March 18th post on Truth Social that Israel had hit South Pars. So part of the South Pars shared with Qatar, where it is known as the North Field, is the world's largest natural gas field and a cornerstone of Iran's economy. The offshore reserve under the Persian Gulf supplies a significant share of global liquefied and natural gas. So, and then we go into this. So the UN warns Hormuz disruption could trigger food crisis as fertilizer supply stalls. Aid officials press for emergency shipping mechanism while governments weigh the economic fallout from the choke point shutdown. So I have talked about this before. I've talked about this over the last couple months. This shortage in fertilizer, major concern. Obviously, farmers need fertilizer, right? What do they need to grow crops? You got to have seeds and you got to have fertilizer, right? Those are kind of the two key ingredients. So this is becoming a very big deal. Now, is this going to be a major deal for the U.S.? Not necessarily. Is this a major deal for Europe and Asia? Oh, you better believe it. Oh, you better believe it. This is to be fun, no pun intended, table stakes. This is table stakes for Europe and Asia. And so they're going to have a vested interest very shortly in basically pressuring for Iran to do something here, to come to the table and get this resolved. And unfortunately, though, the U.S. does not have any, the aid officials there are basically, they're pressing for some kind of an emergency shipping mechanism, right? The U.S. is not going to do that. We're not going to have any, we're not going to allow that, because we want to keep the squeeze on, because the more we keep the squeeze on, the more they feel the pressure, the sooner they come to the table to cut a deal to end this whole thing. So there's not going to be any type of an emergency shipping mechanism there. That's not going to come. And again, why would you? Because if you give them that, you're just going to prolong this whole thing, right? So if you keep the pressure on, that's also going to force the UN and China and a bunch of other players to come back to the table and basically say, hey, we got to wrap this package. We got to wrap this up and get this thing over and done with. So, okay. Now, this was the big bombshell here. The UAE's OPEC bombshell signals a new Middle East order. So after bearing the brunt of Iran's counterattack, the financial powerhouse is strengthening security cooperation with Israel and widening a rift with Saudi Arabia. So the United Arab Emirates' decision to withdraw from OPEC did more than deliver a shock to the cartel that has long ruled the global oil market. It also rang the opening bell for a new geopolitical order that the war with Iran is ushering in across the Middle East. The new alignment is redrawing political fault lines between the Arab world and Israel that defined the region for decades. Instead, the UAE, the financial nerve center of the Gulf and a potential military power, is strengthening security cooperation with Israel as both states work to change the region's strategic balance through force of arms if necessary. Israel recently sent in its Iron Dome missile defense technology and troops to operate it to the Gulf state. People familiar with the matter said something that would be unthinkable elsewhere in the Arab world. The war has given the UAE, a small and fantastically wealthy federation of monarchies, an opportunity to emerge from the shadow of its larger neighbor, Saudi Arabia, and make a statement about its aspirations for regional power. The UAE pointedly signaled its new priorities by announcing its exit from the Organization of the Petroleum Exporting Countries, the one body the Arab world has ever been able to use to throw around its collective clout at the exact moment Gulf leaders were meeting in Saudi Arabia in an attempted show of unity. The decision was time to deliver a shock and to make a statement to the UAE's national interest comes first. Emirati officials familiar with the decision said the UAE is also rethinking its ties to organizations, including the Arab League and the Organization of Islamic Cooperation, according to officials familiar with the discussions. Asked for comment, UAE officials said no further withdrawals are planned for now. The UAE has practical reasons to pull out of OPEC. Production quotas have bottled up around 30% of its output capacity at a time when it could use the revenue to offset war-related pressure on its earnings from tourism and business. Leaving OPEC gives it the flexibility to aggressively ramp up its oil production on its own terms and direct capital towards securing its export routes by investing more in pipelines designed to bypass the Strait of Hormuz, which Iran has all but shut down in the wake of attacks by the U.S. and Israel. So again, I mean, this is just you talk about a geopolitical bombshell in the oil markets. I mean, this is just, just amazing. And this again, I do not think you can underscore how big of a deal this is. I mean, the fact that the UAE is saying that they're going to leave OPEC. I mean, that is a monument. I don't even know if monumental is big enough a word. It is a massive shift in just in everything, and the shift of power in politics and the oil market. Like just an amazing development here over this last week. And again, I don't think you can underscore the just how a profound impact this could have in the months and years ahead as we continue to see this whole thing, shake up and unravel. So, okay. U.S. exports of crude and petroleum production hit record highs. So the global energy climate may shift once again after scheduled peace talks between the United States and Iran have collapsed again. Again, the seesaw. But the U.S. Energy exports have hit record highs as the world navigates the uncertainty surrounding oil and gas shipments through the Strait of Hormuz. U.S. exports of crude and petroleum production surged to a record 12.9 million barrels per day last week, according to data from the U.S. Energy Information Administration. The Energy Information Administration predicted in a separate analysis that net exports of U.S. liquefied natural gas would grow by 18% this year and by another 10% in 2027. So that's fantastic, right? The Department of Energy stated the United States is the world's #1 exporter of LNG and is the first country to have exported more than 100 million metric tons of LNG in a single year, according to a post on X. LNG export terminals are in the states such as Georgia, Texas, and Louisiana, according to the Sierra Club Export Tracker. Exports of liquefied natural gas are expected to rise even more in the coming years, with more than a dozen terminals being constructed or planned in the South. So, thanks to President Trump's energy agenda, the U.S. Energy Department has approved over 19 billion cubic feet a day of new LNG export authorizations, more than America's entire export capacity upon inauguration last year. So, this is a win for America, our allies, and for global energy security. So, yeah. So again, our exports are booming. Exports are doing great in this whole thing. So that is a positive side effect, if you will, of this whole situation. Now here's the drawback. We're gonna get into the negative side of this. So the Fed's preferred inflation measure rises to 3.5% in March amid Iran war. The Iran war has sharply increased global energy prices. All right, so the Federal Reserve's preferred inflation measure surged in March as U.S. consumers continue to face price pressures amid the war in Iran. March's annual personal consumption expenditure, otherwise known as the PCE, price index inflation advanced to 3.5% from 2.8% in February, according to new Bureau of Economic Analysis released on April 30th. This was in line with economists' expectations. And again, this little spike in inflation here is all being driven by energy. It's being by the price of crude and Brent. Like if we go back to our data points here for just a second, if we go to commodities, we could see here crude oil futures are currently trading at $102.50. Brent crude futures are trading at $109.20. So both up over $100. I think Brent crude over the last 5 days, Brent crude, and then I thought they had surged up to $126 at one point here in the last few days. There definitely was a surge there, but let's go back to where are we at? I kind of lost my part. Okay, back here. So, but excluding the volatile energy and food prices, the 12-month core PCE inflation edged higher to 3.2% in March from 3% in February. On a monthly basis, PCE and core PCC inflation climbed by 0.7% and 0.3% respectively. These readings also match the consensus forecast. So President Donald Trump is locked in a standoff with Tehran. Yeah, we know that. So, but again, this spike in inflation is being driven by the increase in energy prices, right? And the hope is that if this conflict can be ended and we can get back to normal, that this will immediately come back down and that gas prices will immediately drop back down. And I think that is difficult to say. I really do, because I think that there is a chance that the prices do come back down, but I don't think it's going to be as quick as Trump thinks it's going to be or says that it's going to be. I just don't see that happening. Why? Because Wall Street likes to make money. The oil companies like to make money, and they're very quick to bring it up, but they're very slow to bring it back down, right? So now let's look at some other things. So California, gas prices keep surging as California tops $6 and see prices in your state. So rising oil prices are pushing pump costs sharply higher again, sending the national average to its most expensive level since the summer of 2022. And, great little chart here showing the spike in prices. So you could see places like, Massachusetts, Pennsylvania, Ohio, Michigan, Illinois. Over here on the West Coast is just getting hammered here. I mean, Washington State, Oregon, California, Nevada, Alaska seeing big surge increases. Hawaii seeing big surge increases. Idaho, Arizona, Colorado. I mean, so again, a lot of these states are getting bludgeoned, pretty hard here. So gas prices have jumped to an average of $4.39 a gallon, the highest level since July of 2022. After a brief dip earlier this month, prices have shot up by $1.41 since the end of February, when the Iran conflict began and oil markets started surging. Gas prices vary widely by state, with a half dozen holding below $3.90, while California has crossed the $6 threshold. So, and then we could see here, gas prices back on the rise after a brief dip. So we could see that we hit that high of over $5 on June 14th of 2022, and that we are now sitting here at $4.39 as of yesterday, as of May 1st. So, and again, this plays big time with politics, right? Like politics are going to play into this, and I'm going to show you guys something else here for just a second. So I just pray to God, Los Angeles drivers hit with $100 fill-ups as gas nears $9. Residents say filling up your car now exceeds $100, with some switching to public transit out of pressure, out of pure necessity. So again, you're seeing in parts of California, you're seeing in Los Angeles, gasoline prices up to $9 a gallon. I mean, that's pretty crazy. And I will tell you this. I don't care how good things may turn out in Iran. I don't care how good our exports might be. I don't care what the bonuses are. For the president, for the Republican Party, you don't fix this, you could kiss the midterms goodbye. Okay, that is just a political reality. People will vote with their wallets. Okay, it was unacceptable during Joe Biden's administration, and it's unacceptable now. So, and it does not matter. You could say whatever narrative you want to say. The bottom line is, if those gas prices do not come down, and if they do not come back down quickly, meaning within the next 3 or 4 months, they could pretty much kiss the midterms goodbye, because that's what's going to happen. So they better pray, like I said a few minutes ago with Iran, where I think that they will come to the table here in the next 2 weeks because of the situation with their oil supplies. But they better pray that happens. They better pray that happens, because if we're still sitting here in September and nothing has been resolved, the midterms are gone. They're out the door. So okay, now let's talk about U.S. debt tops 100% of GDP. So I started out the live stream, as I always do, talking about the federal budget deficit and the total GDP, or the total debt. Now, I didn't want to confuse people at the beginning, because what like I said, let's go back to the debt clock for just a second here. So when I talk about the $39 trillion in national debt here, that's federal debt. That is federal debt. That is not consumer debt. This is consumer debt. So U.S. debt tops 100% of GDP. Federal debt exceeding the size of the economy. So the federal debt is now exceeding the size of the economy, as a potential symbol of the gathering financial stresses on the U.S. So the U.S. national debt now exceeds 100% of gross domestic product, crossing a once unthinkable threshold on the way toward breaking the record set in the wake of World War II. As of March 31st, the country's publicly held debt was $31 trillion, while GDP over the preceding year was $31 trillion, according to data released Thursday. That puts the ratio at 100%, compared with 99.5% when the last fiscal year ended on September 30th. That figure will likely climb for the foreseeable future, because the federal government is running historically large annual deficits of nearly 6% of GDP, which continue to add to the debt. The government is spending $1.33 for every dollar it collects in revenue, and the budget deficit this year is projected at $1.9 trillion. That is a little change from 2025, as Republicans' tax cuts kicked in before their spending cuts take effect. The final tally will depend on Iran war spending, tariff refunds, and the strength of the economy. By itself, the milestone doesn't mean much. There isn't a special level where all debt goes from problematic to catastrophic, and the ratio might bounce around in coming quarters as tax receipts come in, tariff refunds go out, and GDP fluctuates in response to inflation and revisions. Still, the triple-digit mark is a potent symbol of the fiscal stress on the U.S. that has been building for decades. Lawmakers at both parties have expressed alarm, but given priority to tax cuts and spending increases with clear short-term political benefits. So in other words, like I've been saying for years now, both parties don't care. They don't care. They have no desire. Nobody in Capitol Hill has any desire to cut spending one bit. Okay, they're all either more taxes, more tax benefits, whatever they see is more politically beneficial in the short term. That's what they're going to focus on. They're not going to sit there because politicians are politicians, and this is why. And again, the gold standard. People always, our debt didn't, you can literally make a direct correlation to the ending of the gold standard by Nixon in 1971 and where we are at with our national debt today. 50 years, you can make that delineation right back to the moment that Nixon took us off of the gold standard. Now, was the gold standard perfect? No. And I'm not going to get into a whole discussion here on the gold standard, except to say this. The gold standard was, what you have to understand about the gold standard was handcuffs. But it was handcuffs for who? It was handcuffs for politicians. It kept the politicians from doing this, from doing exactly what we are seeing here today. It kept the politicians from spending money just completely absurd ways on massive amounts of welfare and illegal immigration and endless wars and all this other crap. The gold standard, it cuffed them. It prevented them from doing this. That's why it kept our debt in line for a long time. The only time we stepped out of this was during World War II, when we had to, when an unprecedented event of World War II, we had to fight it. We had to spend the money, and it just did. But then what happened after World War II? Oh, that's right. This is when our politicians, a lot of them still had a brain, and a lot of them basically said, you know what? We spent ridiculous to get through the war, but now we got to bring that all back down. Now, it did help that after the war, the economy completely boomed because Europe was in the toilet, and Japan was in the toilet, and everybody had to come to us to buy all their goods and everything, and we had one heck of a manufacturing base. So that all played in our favor, and it eased the pressure of bringing all that debt and bringing that money back down. But by the 1970s and even into 1980, our national debt was still in a pretty, it got back to a pretty good place. But and again, you can see from this chart, right here, here's the national debt rising. So you can see during World War II, we got up to 106% debt to GDP in 1946. But then by 1975, we had brought that all the way back down to 23.2%. This is what I'm saying. And then it wasn't until 1980s, Ronald Reagan coming in, that basically you see, Ronald, great president, but Reagan wanted to spend. He wanted to spend money. So he got, so basically he spent money all the way up, and then through, Bush, and then it was in Clinton that basically the government spending started to subside again, started to come back down. But got in 2001 back down to 31%, but then Bush got in there, and then we had 9/11, and we had and then after the financial crisis in 2007, we're at 35%, debt to GDP in 2007, and then you see it just goes from 2007 on, starting with the financial crisis in 2007, it just goes to the moon. It just explodes out of nowhere. And instead of the politicians basically saying that, hey, we need to fix this, we just lurch from one crisis to the next. And with the Federal Reserve right there to just creating the all bailout, all the time economy, it is just, hey, just print money. Just print money into oblivion. And then we get idiots like that moron economist over in France who writes the book on modern monetary theory, MMT, that basically says, oh yeah, deficits don't matter. You could print money into infinity. It doesn't matter. It's not going to bother anything. It won't destroy the economy. It's just So again, we see here in this chart the pattern of what's going on here. But again, this is why you had the gold standard, because it was the handcuffs that prevented this from what we've seen over the last 50 years. This is what prevented them from spending this money. And the combination of having the Fed there, having the Fed there to write a check anytime the government wants a check. Okay, they can they have a blank check. They take out their checkbook, it's got a blank check, and they can write a check for any amount of money that the government wants at any time. That's why they're there. That's why the politicians want them there. That's why the politicians love having them there. And you know, but if you had the gold standard, they couldn't do this. They wouldn't be allowed to do this. They'd be like, "Oh man, we got to balance the budget, and we need to cut spending because we have to keep everything in balance." Um, and this is why politicians, this is why they hate the gold standard. They don't like people bringing up the gold standard. The anytime you bring up the gold standard, they will immediately dismiss it as some a barber a relic from a bygone age. That was like back in the day when people used to use sticks to make fire. Like, yeah, it's ridiculous. We don't need the gold standard anymore. That's crazy. Um, and yet, what does the central bank spend all day, every day buying for the last 10 years? What are they buying? Oh, that's right, gold. Oh, that's right. They spend all their time buying gold, because they know that gold is real money, and they know that when the what hits the fan, it's that gold that is going to bail them out. They know this, and this is but it's crazy. So. Anyway, and let's look at this thing here. So experts sound alarm as national debt tops GDP for the first time since World War II. Debt held by the public has topped 100% of GDP as economists warned of rising fiscal risks despite a resilient growth backdrop. So the U.S. national debt has surpassed the size of the economy, reaching its highest level since World War II, excluding a brief pandemic-era spike, according to a new data that is sharpening concerns about the country's long-term fiscal trajectory. So yeah, so we know all this. The milestone does mark a symbolic and economic threshold, with federal debt now roughly twice its historical average relative to the size of the economy, outside of a brief distortion early in the COVID-19 pandemic when output collapsed sharply. The United States has not ended a fiscal year with a debt above 100% of GDP since 1946. So, and now, structural pressures begin to build despite the growth. So the development comes as the U.S. economy continues to expand despite warnings about the long-term sustainability of federal borrowing. So, So again, I can't say this. I can't say this enough. We have to cut the spending. We have to cut the spending. I love the fraud initiatives, and that will help. But and who knows? Who knows? I mean, what the fraud could be? The fraud could be $1 trillion. We don't know. We have no idea. It could, but it's what we do know is that, and I've reported on. I've done episodes on the fraud. The Gow just reported massive fraud that could be as high as over $500 billion. So we know that the fraud out there in the government right now is massive. We know that there's a massive amount of fraud that I would estimate is somewhere in the neighborhood of 500 billion to $1 trillion. So okay, so you cut that out, but that doesn't that in and of itself does not solve our problems. The politicians have to come back and they have to cut the spending. They've got to cut the spending. We just do not. We cannot sit back any longer and just spend like we're going out of style. And then this is like the president comes back and he wants to increase defense spending up to $1.5 trillion. $1 trillion wasn't enough. Now we need 1.5 trillion. And I'm sorry. I can't get behind that. I cannot get behind that. It's like, no, it's like I'll tell you what, maybe I'll cut a deal with you here. You cut spending in other places. Okay, you find some other places to cut $500 billion out, and then you can add that back into your defense. As long as you're giving me a wash and you're not adding, okay, let's talk about that. Okay, but as long as you're just saying, oh yeah, we're just going to spend another no more spending. No more spending. We're tapped out. We're broke, man. We're broke. We're broke. So there has to be changes on this. There has to be. At some point, these politicians have to come back to the table and have to seriously start talking about balancing the budget. Getting the net. Beginning to work on finding some way to pay the national debt down. This has to become a major priority. It has to be. So, all right. I'm going to get off my high horse there. So, okay, let's take a look at this real quick, and then I'm going to go to, I want to switch into some bank news and the economic indicators, all that stuff. So, but so big court case that started this week. Obviously, Elon Musk going to court against OpenAI. So I had these two articles here on this. So OpenAI takes aim at Elon Musk's narrative and credibility in Oakland trial. The Tesla CEO continued testimony on the second day of an epic legal battle over the future of OpenAI. So OpenAI, basically the story goes here. Elon Musk created, for those who don't know, Elon Musk created OpenAI. He funded it with his own money. He picked all the people to come in. Now, very importantly, Elon put that together as, wait for it, he put it together as a non-profit. It was always meant to be a non-profit. It was not meant to, be this huge cash cow generator, because it was meant to develop AI that was going to benefit humanity. That was the point. Sam Altman, okay, had other ideas. Sam Altman looked at it as the vehicle rather, to make him disgustingly rich. And this was going to make him, a multi-billionaire and make him one of the tech bro fintech players out in Silicon Valley. And so basically Elon has come back now that there's this huge war has erupted between him and Sam Altman. And Elon is basically coming back saying, wait a minute, you hold on, you stole this company from me, and this company is a nonprofit. And what Elon is asking here is for the company for Sam Altman to get the boot, and for the company to get put back and remain as a nonprofit. So so that's really what the argument. Now, again, Elon testified for a couple of days this week. The attorneys for OpenAI continue to jab at back at him. I don't think very effectively. And then let's look at this. So Musk's testimony dominated the first week in Musk versus Altman. You can't just steal a charity. So the first week of the Musk versus Altman trial concluded on Thursday, with proceedings set to resume next week. Tesla and SpaceX CEO Elon Musk testified over the course of 3 days, hammering home his argument that OpenAI Sam Altman and Greg Brockman were trying to steal a charity. Musk sued OpenAI, Altman, and Brockman in 2024, alleging they went back on their promises to keep the AI startup a nonprofit. Now, here's what's really interesting. Elon has basically said, that this case is really not about so much OpenAI and him, and this is really gets back to the point of a charity. Like, what are you allowed to do to a charity? I mean, if you could just basically steal a charity, so to speak, and turn it into some for-profit, and and just completely morph that charity into something that it was never meant to be, and basically you're basically setting a precedent here. If Sam Altman and OpenAI are allowed to prevail in this case, you're setting the precedent that basically anybody could just come into any charitable organization and just completely do what they want with it. That would be a horrible precedent to set. So again, it adds a very interesting wrinkle to this. So let's see here. So Musk's testimony was the centerpiece of the trial's first week. It comes 2 years after the Tesla and SpaceX CEO first sued OpenAI, alleging they went back on their promises to keep the artificial intelligence startup a nonprofit and to follow its charitable mission. Musk, who helped to start OpenAI in 2015 as a nonprofit, claims that the roughly $38 million he donated to the project was used for unauthorized commercial purposes. OpenAI, now valued at over $850 billion by private investors, has called Musk's allegation baseless. Musk left OpenAI's board in 2018, and 5 years later started xAI as a competitor before merging that business with SpaceX in February. So again, this is very interesting. So Musk testified that he is not entirely against OpenAI having a for-profit unit, but he said it became the tail wagging the dog. He repeatedly accused Altman and Brockman of enriching themselves from a charity while also reaping the positive associations that come from running a nonprofit. What you can't do is have your cake and eat it too, Musk said from the stand. Musk said he started OpenAI to serve as a counterweight to Google, which he viewed as having insufficient concerns around AI safety. Musk said he got into an argument about the subject with co-founder Larry Page. But and that basically OpenAI wouldn't exist without him. So again, but just fascinating. So let's see here. Musk's attorney said their client should receive up to $134 billion in damages from OpenAI and Microsoft, which is also named as a defendant. Musk's team now says any ill-gotten gains should be returned to OpenAI's foundation. Musk is also seeking to have Altman and Brockman removed from their roles and to unwind OpenAI's for-profit conversion and restructuring. All that's happening while Musk and Altman are pushing their respective companies towards public offerings that could be the largest in history. Yes. So again, we will, so before the proceedings kicked off on Monday, Judge Gonzalez Rogers opted to split the trial into two parts: a liability phase to determine whether any wrongdoing occurred, and a remedies phase to decide the appropriate outcomes and next steps. So Gonzalez Rogers expects the former to conclude by May 21st. The jury will weigh in during the liability phase only, and its verdict will be advisory, which means that Gonzalez Rogers will make the final decision. So very interesting. So we shall see what happens here. A lot of power in the judge's hand here in this particular case. So, all right, now when we come back here in a second, we're going to talk about the CBDC bill and how this failed. And I also want to harp on the fact that there was so little coverage of this, and Washington did what Washington does here. And like I said, I'm gonna hold off on that for just a second. You know what I just realized? I did not bring up. You know what? If you guys want to bear with me for a second here, I'll see if I can find this real quick. Let's see here. Bank groups. All right, let's go another way here. I'm gonna give me a second here. I'm gonna find this for you guys so we could do our economic. That's not what I'm looking for here. Let's go back here. All right, this is annoying me now. Hang on there. Hang in there for just a second here. What is that? That's not what I'm looking for here. I'm not having a good time with this. All right, come on. It's got to search. All right, here we go. This is what I was looking for here. Okay, here we go. Here are our economic indicators. So, okay, let me make this a little bit bigger here. There we go. All right. So, all right, I'm going to switch gears here. So this is the point in the show where I like to talk about the economic indicators. I like to talk about the episodes that I had that came out this week. And I also like to give everybody a little bit of banking news. So let's go into, as you can see on the screen here, the economic indicators coming out this week. So on Monday, May 4th, we have factory orders. On Tuesday, May 5th, we have trade balance, services PMI, JOLT job openings for March, new home sales for March, API weekly crude oil stock. On Wednesday, May 6th, we get the ADP non-farm employment changes. On Thursday, May 7th, we get initial jobless claims, continuing jobless claims, construction spending, consumer inflation expectations, consumer credit for March. And then finally, on Friday, May 8th, we get the average hourly earnings, we get the non-farm payrolls, we get the participation rate, the private non-farm payrolls for April, the unemployment rate for April, the Michigan consumer sentiment for May, and the U.S. Baker Hughes total rig count. So those are the economic indicators. A lot of stuff coming out this week, and I will bring all that stuff to you guys on next week when we come back. So, okay. Let's get everybody some banking news here. So personal income and spending rise in March. GDP was up to 2% in the first quarter. So gross domestic product increased at an annual rate of 2% in the first quarter after rising 0.4% in the fourth quarter. So GDP starting to get a little bit back to normal there. Weekly survey, mortgage applications declined this week. So mortgage applications for new home purchases decreased a seasonally adjusted 1.6% for the week ended April 24th. Durable goods orders increased in March. Housing starts were up and building permits were down in March. Consumer confidence increased in April. So the Conference Board's Consumer Confidence Index increased by 0.6 points in April to 92.8%. Home prices increased slow in February. So that's good stuff. Consumer sentiment was also down in April. USDA issues second disaster payments to farmers and extends deadline. So that's good news. The CFPB, they published the 1071 final rule with key community bank exemptions. I actually have an article for this that we'll get into in a few minutes, but this aligned with ICBA's repeated calls for policymakers to exempt community banks from the data collection requirements. So the final rule will exempt institutions that originate fewer than 1,000 covered small business loans per year. It defines small businesses as those having gross annual revenues of $1 million or less, and it exempts agricultural loans, so farm loans. So that's good. So like I said, we'll talk about that a little bit more in a few minutes. A new poll that was conducted by ICBA has Americans strongly supporting community bank policy priorities. So supporting reforming credit union policies, with 58% saying Congress should investigate whether credit union tax and regulatory exemptions are still warranted. Support policies to promote community bank formation and lending, with 58% saying the formation of new community banks is important to the health of the nation's banking system. Oppose overhauling the credit card system, with 63% saying consumers would bear the cost of changing the technology. Support preserving the separation of banking and commerce, with 61% saying the industrial loan company loophole increases risks to the financial system. So, okay, and then ICBA urges the CFTC to ban prediction market speculation on banks. So again, this is another interesting wrinkle with the prediction market. So ICBA urged the Commodity Futures Trading Commission to prohibit prediction market speculation on a bank's survivability. ICBA opposes charter application for Lorem National Trust Bank. So again, ICBA expressed opposition to the Lorem Group Holdings Inc. application for a de novo national trust bank charter called the Lorem National Trust Bank. So, and ICBA has basically been opposing all of these things, so it's no shock there. The House does pass the Farm Bill, which we will talk about in a minute. Latest credit union acquisition puts tax fairness front and center in Washington, D.C. Yep, I have an article on that. We'll get into that in just a few minutes. Poll in digital assets debate. Community bank support dominates. Heading into this week's ICBA Capital Summit, new polling data show that Americans support community banks and want to ensure the industry is not harmed in the current debate over digital assets policy. So 65% say it is important for policymakers debating crypto policies to ensure digital assets avoid harming bank lending in local communities. 62% say policymakers should ensure crypto policy preserves consumer access to insured deposit accounts. 74% say banking with a bank based in their local community is important to them. And 74% say that when deciding whether to place money and investments, it is important that the institution is part of the regulated banking system. Okay, FDIC warns of ramp and dust schemes. So the FDIC Office of the Inspector General warned the public about a type of investment fraud known as ramp and dump. So this is similar to what is known as a pump and dump scheme. Ramp and dump schemes feature Chinese or other small cap non-US companies that obtain a listing on the NASDAQ and go public, while bad actors are allocating millions of pre-IPO shares at little to no cost to themselves. Well, shouldn't the NASDAQ be dealing with that? I mean, shouldn't they be policing the companies that they're putting on the exchange? I would think that would be obvious, right? Apparently not. So NACHA, my favorite acronym in the banking business, NACHA, increases same-day ACH per payment limit to $10 million. So NACHA announced that the same-day ACH per limit will rise to $10 million under a rule change approved for its membership. This aligns with dollar limits with RTP and FedNow, providing consistent dollar limits across payment rails. So yes, good news there. let me see here. I just want to make sure I think I might have skipped a couple things here. So, ICBA objects to EDX Trust National Trust Bank charter application. So I got an article on that too. So we'll talk about that. ICBA urges Fed to align reputation risk removal with the FDIC OCC rulemaking. So ICBA expressed support for the Federal Reserve Board's proposed rule to codify the removal of reputation risk from the board's supervisory program, though ICBA asked the Fed to strengthen the proposal in several key areas. So, okay, we'll keep an eye on that. Treasury announces CDFI review. So the Treasury Department announced it was initiating a review of certified community development financial institutions to identify potential violations of applicable law or CDFI requirements. So yeah, we'll continue to look at that. OCC proposes streamlining several regulations. The OCC issued a notice of proposed rulemaking to streamline regulations concerning public welfare investments, open market collateralization loan obligations, and Federal Savings Association non-discrimination requirements. Wow, that's a mouthful. Treasury announces Form 990 initiative. So the Treasury Department announced that the IRS plans to revisit the Form 990 to improve transparency related to tax-exempt organizations. So we will keep an eye on that one because that could have some interesting changes. And then finally, OCC announces actions preempting Illinois interchange law. So the OCC issued an interim final rule and interim final order clarifying long-standing powers under federal law for national banks to charge certain fees, preempting a pending Illinois law that restricts interchange fees. So yeah, so the whole interchange fees, the interim rule on exchange fees, this has been going on for a long time now, so nothing new with that. And like I said, we'll continue to follow that to see what happens. So, okay, now let's change gears for a second here. I want to talk about the episodes that I put out this week. Okay, so I put out last Sunday, I put out a BND Strategy Room bonus episode, which was basically just a clip from my Fed conversation from last week, but this was titled Fed Update, Powell Investigation Dropped, and Warsh Confirmation Hearing. So again, if you just want a little bit more updated, if you didn't get the full hour's worth, if the first hour of this live stream wasn't enough for you, you could go back and get a little bit more if you need some, context to what is going on there with the Fed. So, okay. Then on Monday, this was a great one. I did an interview with author Richard Vague about his brand new book, The Banker Who Made America. So this episode was an interview with author Richard Vague. We discuss his new book, The Banker Who Made America, Thomas Willing, and the Rise of the American Financial Aristocracy. The book details the life of Thomas Willing, a banker, merchant trader, and politician who bankrolled the American Revolution and then fundamentally shaped the financial architecture of the new republic. Thomas Willing got his start as a partner in Willing, Morris and Company in 1757. He became mayor of Philadelphia in 1763. From 1781 to 1791, he served as president of the Bank of North America, the first bank in the United States. In 1791, he became a commissioner for the first bank of the United States. That was America's first central bank. Then he served as president of the first bank of the United States. And around 1800, he rose to be the wealthiest man in America. So Thomas was stained, however, with a major controversy. In 1776, as a delegate for Pennsylvania, he voted against American independence not once, but twice. So Pennsylvania's moneyed elite and the emergent lower and middle classes embroiled the politics of 1776 in bitter class conflict. So again, this episode, so if I could show everybody here. So this is the book right here, The Banker Who Made America by Richard Vague. And this book is all about Thomas Willing. And Thomas Willing, a very prominent banker at the beginning of the country. And he played a prominent role with basically Alexander Hamilton and Robert Morris in building what ultimately became, using capitalism and building the American economy. So, we owe a lot of what we have today to those, these three gentlemen. So I think that this book is highly important. But this book also details, just by its title, the rise of the American financial aristocracy. I mean, that's one of the things that this book talks about is basically the politics of banking and how the bankers in the country in those very early days, as they were building the economy and building out the banking system, the financial system in the United States, they were also building a new financial aristocracy and making themselves fabulously wealthy in the process of doing so. So again, but just a phenomenal book. Get a chance, check that out if you get a chance. I think a lot of people will really enjoy reading about this. I think it was very poignant that this book came out here right at the time that it has. And so again, great book at a great time. Learn a little bit about American history. Just a couple other books that I think are very interesting that I'm going to bring up in the coming weeks. Lombard Street, A Description of the Money Market, written by Walter Bagehot. And this is a book actually written in the 1800s. And, we're going to talk about that a little bit. Banking, Currency, and the Money Trust by Charles Lindbergh. Very interesting. There's some very interesting. This is a short book, but it is very detailed and it is very good. And the printing of this is very interesting because it's a very thin, it's very, extremely thin, but just very large format, with very small print on the pages, interestingly enough. But yeah, Charles Lindbergh, he wrote this book being very critical of the money trust and the Federal Reserve. And then not too much later, his baby got kidnapped. Yeah, interesting how that works, right? Okay, and then the other thing I wanted to point out is I covered this book about a couple years ago, Rewired. This was a book that got put out by McKinsey, and this is called The McKinsey Guide to Outcompeting in the Age of Digital and AI. And this is basically like a project manager's book. Like if you wanted to, or if you're really working on any kind of AI initiative, digital transformation, just how to run a technology project in not only a bank, but in any company from start to finish. I just absolutely loved this book. This book was phenomenal. Anybody that you have on your IT staff, you should buy them this book. Buy them this book. They need to be reading this book. I think every executive at any bank out there should be reading this book and talking about it and having conversations about it, because everything that you're doing or need to do is described in that book. Now, that takes me to this. So the second edition of Wired just came out, and this book's even like twice. This book's even bigger and better. So this is revised and expanded second edition of McKinsey's playbook on how leading companies win with technology and AI. So this second book here is focused even heavier on AI and basically what your bank should be doing with, data analytics, building AI models, how to incorporate AI in various aspects. But just a phenomenal piece of work from McKinsey. So this is Rewired, second edition, out now. Go check that out when you have a minute. So, okay. So like I said, just wanted to mention those books there. So, okay. So then the other episodes that I put out this week, on Tuesday, I did overview of the world's largest banks by assets for 2026. I just wanted to take a look at what are the largest banks in the world by assets, but then looking at different areas of the world, right? Looking at Asia, looking at Europe, looking at the US, looking at the Gulf and Africa. What are the biggest banks in those areas? Like, I think you learn a lot about the global banking system by studying the banks that are out there and their different asset sizes. It tells you a lot about what's going on in the banking world. Then on Wednesday, I did what questions should you consider before a capital raise? And this was really interesting. So raising capital can be as much an art as it is a science. There are many factors to consider when deciding to raise capital, such as the size of your institution. Is your bank publicly traded or privately held? Do you want to raise capital using debt or equity? If debt, will it be senior debt or subordinated debt? And is raising capital cheap or expensive in the current environment? Like, so before you do anything, here are 5 questions your bank should consider before conducting the capital raise. Now, I'm not going to go through all 5 questions, but if, like I said, that was a very interesting episode. Like I said, I have an article to share with you guys, and I'm going to relate back to that episode as a reason exactly why I did that. And then on Thursday and Friday, I put out an episode, Deposit Relief or Chasing Deposits. I talked about, just deposit trends, how banks really can't kind of, get complacent, if you will, at the moment with the way that things are going with current deposit pricing, because things could change in that regard very quickly. And then on Friday, I put out, can banks win back small business customers? So I saw a great blog post from PCBB where they covered the Federal Reserve's Small Business Credit Survey. Some very interesting information in that. Banks continue to lose market share, even though community banks are very highly regarded by their customers and still give fantastic levels of customer service. They have still been losing market share primarily to online lenders and larger banks. And so again, that episode just covered that, pointed out a lot of really good information. So if you're interested in that one, go check that out. But those were the 5 episodes for this week. Of course, I'll have more episodes coming out next week. But okay, so now let's shift gears and let's get back to some of our articles here. So, and I got a lot of stuff. Unfortunately, I'm going to blow through a lot of this stuff here as we get toward the end here. But okay. Central bank digital currency, the anti-CBDC, CBDC policy. So, an arcane financial policy idea that conservatives love to hate has become a perpetual nightmare for House Speaker Mike Johnson. House Republicans have been pushing legislation for years that would ban the Federal Reserve from creating a central bank digital currency. Republican hardliners have repeatedly pushed a ban on CBDC in key bills that require Democratic support to pass the Senate. No, actually, they don't. Imperiling their path forward. Conservatives secured their biggest victory on the issue yet Wednesday after convincing GOP leaders to combine the digital currency ban with a bill reauthorizing government spy powers set to expire Thursday. That set up a major clash with the Senate, where Democrats oppose a CBDC ban, and Majority Leader John Thune has warned that a combined bill is dead on arrival. House hardliners' anti-CBDC crusade has contributed to the growing dysfunction among House Republicans. The issue is also bewildering to Senate Republicans who don't want the push to imperil other legislation. First of all, this is all bull. This is all bull, and this just infuriates me, because Washington is always playing this BS game. They're always combining bills together because if they don't like, they do this on purpose, and they do it all the time. And they do it on purpose to either get a bill that is not popular with the people. If they want to get that passed, they link it with another deal that is very popular, and they basically say, listen, we know this bill over here is not popular, but this one really is, and we know you want this, so if you will just pass this, then we could get you the thing you really like, but unfortunately, you're going to have to get the thing you really don't like in order to get the thing you really do like. And then vice versa, if they have a bill that you really want, but they don't really want it and they want to kill it, they'll attach it to something else that's bad that you don't want to vote for, and then it gets killed, and then they sit there and they go, oh shucks, sorry guys, we just couldn't do this, we just didn't have the votes, we couldn't figure it out. And for them to put this nonsense out there to basically say like, oh well, we need Democrats to pass. No, you don't. You just need the Republicans to vote for it, and you'll have the votes, and it'll pass, and it'll be fine. The House already passed this bill. They already passed. There was no reason to combine this bill with their FISA bill, which was just, I mean, ridiculous. There's just no reason for this, and yet they went ahead and did it anyway. So they're probably sinking this bill here, and it is insanely infuriating. And they did this on purpose because they didn't want they don't want central bank digital currency to be banned. They don't want that. They still want it to be there because they want it as an option. As I said earlier, they want that to be there as an option. Oh, you know what? I forgot to share this. I forgot to put this back up. Sorry, everybody. They want this as an option, like I said, as a potential bailout or reset of the United States financial system should the debt and the money that they're printing blow up on them one day. So they want the ability to be able to do this, and it's infuriating that they're putting this in there, and the fact that they then blame it on, oh well, it's the hardliners, that the hardliners just they have to have this when it's not necessary or we really don't need it. That's BS. It's just all BS, and this whole thing is very infuriating. And you're watching all of the crypto legislation here just completely falling apart because the Clarity Act is completely stalled. Now we've got the anti-CBDC Act falling apart. So, the whole framework here for all the crypto legislation is very much in danger. And I'm afraid that what is ultimately going to come to pass here is that they're going to pass some kind of a bastardized, version of these bills, and you're going to get the crypto legislation, which could have been very good. All of a sudden, you're just going to get crap. You're going to get a bunch of crap that is not going to work well. So that was the one big thing. Then we had the House of Representatives did pass a farm bill this week, which was good. So after several months of work and negotiation, the House of Representatives passed the Farm, Food, and National Security Act of 2026, also known as the Farm Bill, with a bipartisan vote. The House Farm Bill passed the House of Representatives, and now we'll head on to the Senate. Let's see here. Almost 400 amendments were filed for the House bill, with approximately 50 considered on the floor, and many were passed on a bipartisan basis. So now this bill heads off to the Senate, where the Senate can't, they can't get out of their own way. So do I have much hope that this will get passed in the Senate? Probably does, but but who knows, man? It's a hot mess. So all right, now we move on to this whole Anthropic mess. So the Pentagon tech chief says that Anthropic is still blacklisted, but that Mythos is a separate issue. So Defense Department CTO Michael Michel told CNBC Anthropic is still a supply chain risk, but that its Mythos model is a separate national security moment. The agency announced it has entered into an agreement with 7 other AI companies that will deploy their technology across the agency's classified network for lawful operational use, whatever that means. Michelle's comments come after a heated clash between the DoD and Anthropic spilled into public view earlier this year. Then we go on to this. White House opposes Anthropic's plan to expand access to Mythos model. Relationship is still complicated despite efforts from both sides to de-escalate. So the White House opposes a plan from Anthropic to expand access to its powerful artificial intelligence model Mythos, complicating the rollout of an AI tool capable of carrying out cyber attacks and sowing widespread disruptions online. So Anthropic recently proposed letting roughly 70 additional companies and organizations use Mythos, which would have brought the total number of entities with access to about 120. People familiar with the matter said administration officials told the company they opposed the move because of concerns about security. The people said some White House officials also worried that Anthropic wouldn't have access to enough computing power to serve that many entities without hampering the government's ability to use it effectively. So, all right, a couple of things here on this whole Mythos Anthropic conversation. So number one, the White House created this whole situation. Okay, they allowed, and I talked about this ad nauseum in last week's live stream, but I'm going to talk about it again for a minute. They allowed all this by basically this we're going to barrel ahead with AI, all everything AI, all the time. We're with no breaks, no stopping, no questioning anything that's going on. So they did this. They barreled full steam ahead into this. Okay, now then they got in a fight with Anthropic. and Anthropic, they blackballed Anthropic. And so then Anthropic goes back and goes, oh, okay, yeah, you want to blackball us? We got something for you. Here, check out Mythos. Okay, let's see the damage that Mythos is going to do. And then Mythos, okay, now the government panics. Okay, now they're like, oh, wait a minute, this thing is really bad. It could wreck our economy. And I truly believe at this point, I was questioning it at first. I truly believe it now. I really believe that Anthropic is using Mythos as a way to get the Pentagon and the White House to back off, to basically to not blackball them and to keep them in the mix and keep them rolling forward. And basically now they're blackmailing the administration with this threat of basically unleashing Mythos. And this is why I said last week that the White House needs to come out. There has to be rails around AI. We have to start getting some rails, some regulation around AI. We cannot do this. We cannot allow this. This is like allowing somebody to just develop a new nuclear warhead. Okay, oh yeah, we're just going to let you develop a new nuclear bomb, and if it happens to go off in the process and takes out a whole state, who cares? Whatever. It's all good. It's fine. We just can't keep going with this. Like this has got to stop. And I keep beating that drum, but it's a problem. So, all right. And then we saw this, the Spirit Airlines. So Spirit is in big trouble, probably going to fail. And then the government stepped in and basically said, hey, we're going to try to bail Spirit out, and then we're basically going to try to, build them back up, and then basically do some type of a company flip, and then we're going to make a bunch of money, and then everything's going to be good. The only problem was the talks basically completely fell apart. The government couldn't agree with bondholders, and because they probably wanted the bondholders to take a major haircut, and the bondholders were basically like, yeah, no, we're not going to do that. So this whole thing, kind of blew up and didn't work out. And now Spirit probably will fail, but they probably also get rescued in a certain respect too, because they probably, the debt holders will probably step in and probably reorganize the company and bring it back out after they've straightened some things out. So may not be the total end for Spirit, but we'll see. We'll keep an eye on that. Okay. Trump proposed this new retirement plan this week. So 4 things to know about Trump's new retirement plan order. So there is a growing bipartisan support for expanding uptake of retirement savings plans. So about 1/3 of the private sector workforce lacks access to a retirement savings plan at work. So President Trump's executive order on Thursday seeks to shrink that gap by rolling out a website to offer Americans low-fee retirement savings accounts from private financial services companies. Trump's embrace of expanded retirement account access, first mentioned in the State of the Union in February, signals Republican support for addressing the coverage problem. Democrats previously had backed legislation that would have required most employers without a retirement plan to automatically enroll their workers in individual retirement accounts or IRAs, but it failed to advance. So here's what we know about the executive order. What is the problem that they're trying to solve? Well, a swath of the workforce lacks access to on-the-job retirement savings plans. How does the executive order propose to solve the problem? Well, the executive order instructs the Treasury Department to launch a new website called TrumpIRA.gov by the beginning of 2027. The goal will be to offer Americans retirement accounts that meet certain requirements, including low fees. Workers would be able to use the website to select an IRA, although that's something they already can do at banks and brokerage firms. Will workers have incentives to sign up? Well, under a law Congress passed in 2022, the federal government will provide up to $1,000 a year for people with low to moderate incomes who contribute to any type of retirement account. So, okay. And then how will the new retirement savings account work? Well, workers could use the government-backed website to find IRAs from financial services companies that accept the government matching contribution. The administration said the site would allow people to sort and select IRA offerings by factors, including fees. To be offered on the website, the IRA would have to provide low-cost investment options with overall net expense ratios of 0.15% or less and no minimum contributions or balance requirements. The investment options would resemble those in the federal government's 401k-like plan called the Thrift Savings Plan. The TSP mainly offers low-cost stocks and bond investments. So, okay. What else we got here? So Trump announces tariff increase to 25% on cars and trucks from the EU. The import tax will go into effect next week, the president said. U.S. proposes board of trade with China in key pre-summit calls. So the board would oversee trade in everyday commercial goods that do not involve national security. So we'll keep an eye on that. Nobody can ignore insider activity on prediction markets now, and nobody knows what happens next. Yes, absolutely. So the Justice Department last week said an American soldier used classified information to reap profits of over $400,000 on a polymarket wager linked to the capture of Nicolas Maduro, the latest development to raise questions about insider activity on the platforms. Kalshi also touts a continuing crackdown on insider activity that has included fining and suspending congressional candidates. It said placed bets on contracts tied to their own campaigns. So yes, so we will keep an eye on the prediction markets here and see how this plays out in courts with a lot of the legal proceedings. So all right, I had, guys, I had a lot of other stuff I had to get to here this week, but I've run out of time here, unfortunately. I just had too much news and too much stuff to get to here. So I am going to go into a wrap-up mode here real quick. So, all right, things I like to touch on here in the live stream. So first of all, if you are watching, or I should say listening on Apple Podcasts or Spotify, please be sure to leave some reviews. The channel could always use your positive views. So if you're listening on Apple or Spotify, please make sure to leave some good reviews. Let me get my banners up here. So make sure to visit thebankernextdoor.com. A lot of great stuff up there on the website, always making changes to the website constantly to try to improve it and make it better for all of the viewers out there to have a good place to go and get financial information. If you have any comments, questions, or topic recommendations, please send them to info@thebankernextdoor.com. That's how you get in touch with me, info@thebankernextdoor.com. Make sure to subscribe on YouTube. As I send out all of the posts, like today is a perfect example. I couldn't do the live stream at the normal time at 8 o'clock tonight, had to move it to earlier this afternoon. I put that out in a post this morning. So, and then, like I said, next week might be doing the same time again on Saturday, might be doing Friday night. I'll have to check, but I will put that post out on YouTube. So make sure to subscribe on there. You can also follow me on Getter, True Social, and X. I will say I do spend the most of my time on X platform, but the BND Banker Next Door is on YouTube, Rumble, and all major podcast platforms. We put out new episodes every Monday through Friday at 12 noon, and the BND Strategy Room live stream is normally on Saturday nights at 8 o'clock. So, okay. That being said, let me go to my story of the week and my quote of the week. So our story of the week here is centered around futures contracts. So on April 21st, 1982, futures contracts tied to the S&P 500 index became available for the first time. Fund managers could buy either the underlying stocks in the index or a futures contract, whichever was cheaper. Program traders using futures to manage risk worsened the single sharpest stock market crash ever just 5 years later. Now, that stock market crash was Black Monday, which occurred on October 19th, 1987, which was caused by a combination of automated program trading, overvalued stock prices, and investor panic, leading to a record 22.6% one-day drop in the Dow Jones Industrial Average. Portfolio insurance, a computerized hedging strategy, caused a massive sell-off loop that overwhelmed systems. So now I know that is the popular explanation for the Black Monday crash of 1987, but a lot of it really had a lot more to do with the Japanese. The Japanese had basically threatened to sell a lot of the national debt that they were holding in the form of bonds and treasuries, and they were threatening to dump that on the market. So again, I'm not saying that all this stuff didn't play into that, but the main culprit there at that particular moment was the Japanese, because the Japanese threatening to dump all the national debt is what triggered a lot of those other dominoes to basically fall down there. So anyway, okay, now our quote of the week here. So our quote of the week here comes to us from Arthur Schopenhauer. Now, Arpit Schopenhauer says this: talent hits a target no one else can hit. Genius hits a target that no one else can see. So I like that a lot. So again, talented people are able to accomplish a lot of tasks, but the geniuses out there are able to accomplish the things that no one really sees in front of them. So great quote there from Arthur Schopenhauer. So, and again, just another shameless plug for Richard Vague. If you didn't watch my interview with him, please go on YouTube, check that out, or any of the major podcast platforms for that matter. And please pick up a copy of his new book, The Banker Who Made America. I'm sure he would really appreciate that. I get no benefit from that. I get no benefit if his book sales go through the roof. Great, good for him. He makes a lot of money. I get no benefit from that. I wish I did, but I don't. All right, everybody. Well, that's the show I have for this week. I hope everybody has a great time out there. We've got sports galore this week. We got the Kentucky Derby. We got hockey playoffs, basketball playoffs, baseball going, all kinds of stuff raging. But I hope everyone has a great weekend out there. Just be safe. Have a great week. Check out new episodes coming out this week. And then I'll be back next weekend to see you again for another episode. You'll be back in the strategy room. Have a great weekend out there. See everybody later.